Welcome back to the channel. If you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a company called AB's Budget Group, ticker CAR, and the company is currently trading at $110. Still recovering from a massive drop that experienced back in February when the company was trading around $170. And as you can see, dropped precipitously and it's been going sideways ever since. So why do I think this is a short candidate at the moment? And if we zoom back, you see that it's been trading sideways since 2021. So why do I think now is a good opportunity? Well, let's first look at the sector comparison. There's not many companies that we can get a fair representation with these guys. Arguably, I'm getting Lyft as one of them, but really the closest thing we can get is Hertz, which you may have heard has also dropped massively, and I'll show that in a minute as well. But ultimately, we have a company here that is trading at 9 times PE. As you can see, that is after this rise in valuation here, uh, which happened in May, significantly higher than we are accustomed to see. And if we zoom out, you see that that is very much been the case even before the pandemic. And there are reasons for this. First of all, we have with this organization a fleet that is rapidly depreciating because of inflation. But also, we have a change in the regime of market, the regime of environment that we have been. Let me zoom out to illustrate the point. So we're currently sitting here, and if we look at where we have been most of the time since 2008, where this massive spike and upward movement has been in a low interest rate environment. So with that tailwind, which is very, very important for this stock, we can see that uh, today's valuation would be middle of the range, so to speak. And you could still find occasions where you had lower valuation than that. But that's not where we are today. Today we are in a probably what's going to be higher for longer environment where we see interest rates at 5 or who knows, maybe a little bit more. The ISM was reported recently and it was positive. So I see more and more the diminishing probabilities of rate cuts happening anytime soon. And that's one of the reasons why I'm choosing to play this as a short, because we will be having that catalyst, which is the Fed meeting happening next week. So that's from a PE standpoint. Now, from an EV to sales standpoint, because this is also quite important as well, you can see that this is the top performer. However, that's not to say that it can get to the level that Hertz is trading at. And in order to look at that, we have to look at the debt, which, as you can see, is quite significant. So the company has debt of 27 billion versus a market cap of about 4 billion. So as you can see, the debt is so much greater than the market cap itself. And that's the problem that Hertz had quite some time ago, which led it to, I think it went bust and then got restructured. So I think that scenario could happen again, and we'll have a look in a second about the catalysts that may drive that. In the meantime, well, what can we see over the last few years? You can see stagnating revenue growth, uh, profit margins being shrank, You can see that happening with net income as well, and also with EPS, right? So at the moment, currently has half a billion in cash versus the massive pile of debt that it has. And the cash from operations last year was actually negative. So definitely not a great picture. What we also have, if we look at the quarterly performance, is that you could see at the end of last year, Q3 2023, some of these things improving, right? So revenue taking up, gross profit margin a little bit as well. Same with EBITDA, net income, even though the EPS was still negative. But the interesting thing is that you still see this negative trend getting traction over the last couple of quarters. So we have stagnating sales growth again. Uh, and again, that translates into negative EPS. So I see this company getting into a more and more difficult position every quarter. So if we look at how that translates into how this year is going to be, so they're expecting a 72% EPS decline. Now, that's pretty low expectations, and a risk that we could see with this stock is that they actually beat those low expectations and the stock rallies. That is certainly a possibility. But the structure that I'm proposing does not necessarily include that earnings reports. And therefore, I'm kind of like getting away from that risk. That's something to bear in mind. And in terms of why am I choosing this company? Well, look at what happened to Hertz back in the past. Very, very similar business model. It had a similar moment, right, where they had this massive drop in 2023, then went up a little bit only to go near zero, basically. Now with Hertz, the price is pretty low, and so there's no massive room for downside risk, especially if you're playing that with options, which I am. So that's one of the reasons why I'm choosing Avis as my play here. Now there's other reasons too. So first of all, I think there's negative momentum going at the moment. Last earnings was not great, even though the revenue surprise was positive. They beat revenue by 31 million. They still have they still miss on EPS on both normalized and GAAP. And the interesting thing about that is that they expect the next quarter to be even below that, and the same goes for EPS on a GAAP basis. Now they keep having this bullish expectation for revenue, but you have to ask yourself if that is simply a matter of them pushing up services in line with inflation. If we don't adjust that, then on a nominal basis, it's not necessarily that meaningful. So 2.55 times, I don't know what it's going to be, 20%, a little bit more. 255 times 1.3. Yeah, so it's about a 15%, so it's definitely not great by any mean. And more importantly, there's been over the last 90 days quite a strong consensus from the analyst community downgrading their EPS for the upcoming quarter. Now you can see how the stock has reacted negatively to this, but I think there is further room to that because those revisions happened during the month of April and May. And you can see how the stock has already recovered a little bit. Now it's kind of like sideways and it's just dropped for the second time from this SMA. So to me, that signals a good entry point into this short position. Now, the other thing is that there's a bit of a dichotomy with the revisions of revenue going up, but also going down. So to me, that could be interesting because it creates a bit of a, it's not a consensus position in the analyst community, and that also creates a little bit of volatility down the road, in my opinion. Um, Next, we have to look at the used car price index as well. This is something that is massively important for them because depending on the price of used car prices, that is the bulk of their assets. And so they have been depreciating for quite some time. And you can see that they recovered a little bit here during April and May. Again, this movement here, funnily enough, resembles a little bit the movement that we see here in April and May of the stock price. But what we can see as well is that there's a little bit of a weakness returning here. So getting to a peak right over here, and then dropping again as we enter June. So I think that trend can continue. And if it does, it's definitely going to impact negatively the stock. Now, something to make this even more important for them, this thing about the used car prices, is that not only the assets are depreciating, but the level of utilization. So you can see that, for example, on rental days, right? Like how much those assets are being used keeps going down. So look at how the rental days has decreased uh, to lower levels over the last few quarters. So to 11 to 13, and then back to 11 and 10. So you see those numbers, they keep going down. The rental fleet, right? So you get to the 180, 180 to 100, and then back down to 170. And the number of days as well. It doesn't seem to be going up either, right? So overall, you get this rate of utilization that is in between 60, 64, 70 mostly, but it's definitely not great considering that at the absolute lowest in Q2 of 2020 was getting at 40%. So, I mean, in my mind, if this is the absolute worst when everything's closed and you cannot literally get into a car, you cannot rent a car, this level of utilization does not look great to me either. I mean, the absolute best you can actually find is 71%. So it's not going to get much better than that figure. This is back in 2022 when most of the restrictions were being eased and people were desperately trying to go on holidays. So I don't see how these numbers can get much better in terms of utilization. Now the other thing is costs. So you have the costs significantly going up. So you can see how they get from 90 to 78, all the way to 120, and now retesting this close to 160 level. The last one was 149. So again, to me, all this makes a scenario where the probabilities of the stock going down are definitely higher, in my view, than uh, than the company going up. And again, we have the upcoming catalyst for the Fed. So with this current setup that we have, uh, just dropped from the 110 level, which is a play that we can use with options here. We could buy some July 110 puts at 665 and sell some June 110 puts at 420 on a ratio. That, assuming we reach a price target of 95, can provide us a 80% return. If it goes lower than that, potentially lower. If we don't get it quite right, maybe we come back to this 130 levels and then we come back down. Could be more. But that's the way I'm going to play it. Hope you enjoyed the video and see you soon.